Hello students, in today's video we are going to study about purchase consideration. Now what is this purchase consideration? Let us first read the meaning. According to Accounting Standard 14, purchase consideration is the aggregate of the shares and other securities issued and the payment made in the form of cash or other assets by the transferee company to the shareholders of transferor company. So according to this definition, purchase consideration is the total value of shares and other securities and the payment that is made in cash and in the form of other assets by the purchasing company to the shareholders of selling or vendor company. See, when a business is being purchased by a company, you have to pay a certain price for purchasing the business. So, the price which is payable by the purchasing company to the selling company, that price is called as purchase consideration. Okay, so this payment is made in the is usually made in the form of equity shares or other securities. Sometimes even cash is paid, or even in the form of assets the payment can be made. But when it comes to amalgamation in the nature of merger, the payment of purchase consideration has to be done in equity shares or other securities only, and only for fraction of shares cash can be issued. So remember, purchase consideration is nothing but the price which the purchasing company has to pay for purchasing the business of other company, and this price is paid to equity shareholders. Okay, because they are the owners of the company. So the price that is paid to equity shareholders is called as purchase consideration. Now there are several methods to calculate purchase consideration. Okay, so let us now study what are those methods of calculating purchase consideration. Basically, there are 5 methods for calculation of purchase consideration. First one is lump sum method. Second one is net worth or net assets method. Then shares exchange method, net payment method, and intrinsic worth method. So let us study one by one these 5 methods of calculation of purchase consideration. We will be also solving problems based on this method. So let us now start with the first method, that is lump sum method. When transferee company agrees to pay fixed sum to the transferor company, it is called as lump sum payment of purchase consideration. This method of calculating purchase consideration is very simple. Okay, here the transferee company agrees to pay certain amount to the transferor company for purchasing the business. So when an amount is decided, that is called as lump sum method. That amount is paid and the purchase consideration is settled. So this is a very simple method of calculating purchase consideration, wherein a fixed sum is decided and it is paid to the selling company, by which you can easily purchase the business. Now let us understand this with the help of an example. M company purchases the business of N company and agrees to pay rupees 50,000. Now M company is purchasing the business, so it is called as transferee company, and the business of N company is taken, so N company is transferor company, and the amount agreed to be paid is 50,000. So the amount which is agreed to be paid by M company to N company, that is the amount of purchase consideration. So our answer will be purchase consideration is rupees 50,000. Very simple method. Okay, the amount will be clearly given in the problem. You need not do any calculations for that. So this is the first and easy method of calculating purchase consideration. Now let's study the next method for calculating purchase consideration, that is net assets or net worth method. So to calculate purchase consideration under this method, we have this formula. The formula is like this: assets taken over, from that you have to minus liabilities taken over. Okay, so whatever remains, that is net worth or that is net assets. Okay, so this is how you calculate purchase consideration under this method. Okay, so but here when we say assets, okay, there are certain things to be kept in mind while using this method. Now what are those? Let us go through once. When I say assets, assets include fixed assets, goodwill, cash or bank balance, stock and or bills receivable, but assets exclude preliminary expenses, discount on issue of shares or debentures, profit and loss account, debit balance in the sense any losses. So very simple thing to keep in mind is assets include all the asset except for fictitious assets like preliminary expenses, discount on issue of shares, and if there are any losses. So while solving the problem, we have to keep these things in mind, what assets include and what they exclude. So we have to remember that assets include everything except fictitious asset. Okay, next is liabilities. Now when we say liabilities, so liabilities include mean these things have to be taken in the problem. They are creditors, bills payable, debentures, outstanding expenses and bank overdraft. And liabilities exclude general reserve, reserve fund, profit and loss account profit, securities, premium. So in short, when we say liabilities, so we mean that we have to take only outside liabilities. Internal liabilities of the company, just like reserves and shares, they are not to be taken while solving the problem. So we have to include only outside liabilities and exclude inside liabilities. So once again, just look at the formula. It is assets taken over, so we are going to take all the assets except fictitious asset, and when it comes to liabilities, we are going to only take outside liabilities. So when we take all the assets and minus outside liabilities, we will get net assets or net worth of the company, using which we will calculate purchase consideration. Okay, so please remember this formula, okay, so that we can solve problems in the next class. With this, I conclude for today. Thank you.